Nice business if you can get it. Big question, is the market, is the world going to pull the plug on Portugal next? And the big kahuna, Spain, remains around the corner. Aaron Smith, Managing Director, Superfund Financial in Singapore, joins us from our studio there. Aaron, morning. What's the answer to that question? Is it black and white, yes or no, when it comes to Lisbon?
Well, we don't know exactly what will happen with Lisbon, but we know the broader context that overall the countries in Europe have a big problem because of a systemic credit that is pervasive throughout the financial system worldwide. So whether it's Portugal, whether it's Spain, eventually some of these sovereigns are going to be in trouble. They're going to need bailouts, and that's going to lead to a situation where interest rates will creep up worldwide. And then you'll start to see some of the larger industrial nations in the West and possibly even Japan start to look at higher interest rates. When that happens, that will be the quote-unquote big bang in the financial markets.
It sounds like, from what you're saying, Aaron, that when you get down to the very bottom of it, you need to be more defensive in nature with the way you approach the world than ever before.
Well, that's right, Bernie, but the way to be defensive, the new defensive, so to speak, is actually counterintuitive. Most investors these days are just sitting in cash or, just holding on to interest rates in order as a defensive strategy. But realistically, this is very dangerous because when we see the interest rates start to creep up, bond prices will fall. At the same time, the actual currencies on which this paper is printed will lose purchasing power. So you will suffer from a double loss. Therefore, you have to look at more offensive strategies such as equities, equity market neutral strategies, or long positions in commodities that have a chance to outperform inflation and protect the integrity of your purchasing power.
Okay, sounds like there are still some very attractive parking places. Aaron, we'll continue this convo in a little bit with specifics. Aaron Smith returns to us from Superfund Financial Private Limited in Singapore in a little bit. Aaron Smith returns to us from Superfund Financial. Hey, Aaron, since I mentioned that little blurb there, where's the consumer in your whole thought process and your whole paradigm? I mean, people talk about, boost domestic consumption, boost the Chinese consumer, get the Japanese to spend it. But as we saw this morning out of Japan, the Suzukis are just clutching onto their yen with dear life more than ever before.
Well, even the optimistic consumer is already laden with debt, especially in the West. If you look in the U.S. or Western Europe, we cannot assume that any economic recovery can come from continued credit expansion. You can't continue to borrow money to buy lattes and to buy to consume and then not have anything to show for it. That economic model that we've all profited from for the past 30 years is essentially dormant at this point, and we're going to actually have to pay for that in the coming decade. We had a great opportunity to pay for that in the meltdown in 2008. But with the bailout of the financial system, all that's done is it's kept a broken system on life support. And so that means basically for the foreseeable future, we have an economic situation that will be stagnant. And on top of that, we can expect the purchasing power of our money to be less and less over time.
Interesting. We just put a little strap up there. One of your, principles as it stands now is you've gotten very, very sick and tired of people talking about central banks printing money. Are you saying that QE2 is not all it's cracked up to be, and we really shouldn't be talking about that? We're concentrating on the wrong thing?
Well, I don't disagree that central banks are increasing the money supply. I just think it's a misnomer to say that they're printing money. The M1, or the actual paper supply of U.S. dollars, is less than 2 trillion U.S. dollars in the world, which is just a fraction of the overall money supply. So when we see central banks increasing money supply, it's not that they're actually printing money. They are printing money, but that paper money is just a fraction of the money supply that's increasing. Money itself is just an entirely theoretical concept. Basically, the money that we have in our accounts are just electronic zeros and ones stored on a central bank hard drive somewhere. So the whole thing is so esoteric, we've gotten so far away from any concept of real value, such as the past 3,000 years when we use precious metals like gold as a store of value.
Yeah. Great. I've been working all these decades just for binary code. Aaron, finally, strategy. You still remain tolerant of risk. Long equities, long precious metals. You highlight silver. the poor man's gold. I had somebody earlier that said platinum had completely underperformed the other precious metals classes. You'd also go along on the softs in the commodity space as well. Give me a 20-second wrap up on why, where, when, and how.
Well, a little bit of volatility, a little bit of risk will set you free. If you look at silver, gold will continue to go up. It's in a strong uptrend. It will still have 20 to 30% volatility. Silver is just, in fact, a leveraged gold. The gold to silver ratio is extremely high. We expect it to cut in half. So the upside potential for silver, once that big bang in the financial markets comes and interest rates start to go up, the reality is that silver is going to be trading at north of $60 an ounce.
All right, Aaron, thanks. If I don't see you before the holidays, you have a happy Hanukkah, Merry Christmas, Happy Kwanzaa, okay? See you soon. Coming up next, escalating labor costs taking its